Hey everyone, welcome back to the channel. Today we're diving deep into Oracle Corporation, ticker ORCL, and breaking down why this stock is making waves after its latest earnings release. The numbers look strong on the surface, but there's a lot more going on under the hood that every investor needs to understand. Let's kick things off with a quick overview of where Oracle stands right now. The company just posted record fiscal fourth quarter results, driven by explosive cloud growth, yet the stock sold off sharply as investors digested massive new spending plans and concerns around free cash flow. This isn't your typical earnings reaction, and it sets up an interesting opportunity to look at the full picture. Oracle has been a cornerstone of enterprise technology since 1977, headquartered in Austin, Texas, with about 159,000 employees worldwide. Its core business revolves around database software, cloud infrastructure, and enterprise applications like PeopleSoft. Under CEO Michael Sicilia, the company has shifted aggressively into cloud computing, and that's paying off with cloud revenue jumping 47% to $9.9 billion in the latest quarter. The Americas region continues to drive the majority of sales, while EMEA and Asia-Pacific round out the geographic mix. Breaking down the revenue segments for fiscal 2025 shows the cloud and license business generating $49.23 billion, far outpacing the hardware business at $2.936 billion and services at $5.233 billion. That cloud momentum is the real story here, with management highlighting a massive $630+ billion backlog that signals strong future demand. The shift toward subscription-based cloud offerings is clearly reshaping the revenue profile in a positive way. On the earnings front, fiscal 2026 delivered revenue of $67.358 billion, up significantly from $57.399 billion the prior year. Net income reached $17.087 billion, translating to diluted EPS of 5.83. Gross margins held steady around 66%, while operating income climbed to $20.778 billion. The headline beat was solid, but the real focus shifted to forward guidance around sharply higher AI-related capital spending, which spooked the market and sent shares down more than 8% in one session. Management commentary from the recent earnings call emphasized the strongest booking quarter on record and the strategic positioning in AI and cloud infrastructure. They pointed to robust demand momentum and long-term growth initiatives, while acknowledging supply chain and currency headwinds. The tone was optimistic on the demand side, but investors zeroed in on the spending trajectory and its impact on near-term cash generation. Looking at the balance sheet, total assets reached $261.759 billion by fiscal 2026, supported by $31.289 billion in cash. Total liabilities stood at $218.703 billion, with stockholders' equity at $43.056 billion. The cash flow statement reveals operating cash flow of $31.977 billion, but heavy investments in property, plant, and equipment of $55.663 billion turned free cash flow negative at $23.686 billion. That's a clear signal of the aggressive build-out phase Oracle is entering to support its cloud ambitions. From a valuation standpoint, the trailing price-to-earnings ratio sits around 37.6, with a price-to-sales multiple near 9.6. Enterprise value is roughly $737 billion, and the debt-to-equity ratio has climbed to 4.21 as the company funds its expansion. Forward PE estimates trend lower over the coming years, suggesting the market is baking in continued earnings growth if Oracle can execute on its cloud and AI roadmap. Turning to the SWOT picture, strengths include record bookings, a dominant position in enterprise databases, and accelerating cloud adoption. Weaknesses center on the heavy capital spending cycle, pressuring free cash flow and rising debt levels. Opportunities lie in federal modernization contracts and expanding AI infrastructure demand, while threats include cybersecurity vulnerabilities like the recent PeopleSoft exploit and broader macroeconomic pressures on IT budgets. Recent performance tells its own story. Over the past week, shares dropped nearly 20% amid the post-earnings sell-off, though the one-year return still clocks in at about 4.4%. Longer term, the 5-year gain exceeds 122%, reflecting the successful cloud transition. The stock is currently navigating a volatile stretch as investors weigh growth potential against execution risks on spending. For the intrinsic value lens, a discounted cash flow approach using standard assumptions points to a value well below current trading levels. This highlights the premium the market is assigning to Oracle's growth narrative and the importance of monitoring how quickly that heavy investment converts into sustainable cash flows. The model delivers a DCF estimate around $61 per share, alongside a MarketSnap valuation near $130, both notably lower than recent prices in the $180 to $210 range. That gap suggests the stock is pricing in significant future success, so any delays in data center rollouts or margin pressure could lead to further volatility. Wrapping up, Oracle remains a powerful player in the enterprise cloud space with impressive demand signals, but the current spending surge and cash flow dynamics introduce real risks worth watching closely. If you're thinking about adding exposure here, focus on the long-term execution of that $630 billion backlog and how management balances growth with returns for shareholders. Thanks for tuning in. Drop your thoughts in the comments, and I'll catch you in the next one.